What if everything you were taught about money was only half true? Most people believe banks take your deposits and lend them out. That money comes from labor, government, or gold, and that the Federal Reserve simply manages what already exists. Welcome to the Financial Codex, but the real story is far more powerful, far more invisible, and far more unsettling. The law that made debt our currency has shaped the entire economy, influencing every bank transaction, every household budget, and every financial decision without most people realizing it. Imagine walking into a coffee shop and paying for your latte. That $5 isn't just cash exchanged for goods. It represents debt, a legal obligation issued by a bank and created out of thin air. Do we spend money, or do we circulate debt? Who truly controls this system? Understanding this is key to seeing the financial world clearly. Money once had tangible value. Gold, silver, and commodities were exchanged directly. Lending required actual assets. In the early 20th century, that changed. Governments and banks realized that loans could become currency themselves. The Federal Reserve's creation in 1930 allowed banks to issue notes legally, making debt a medium of exchange. Suddenly, ordinary citizens unknowingly participated in a system where borrowing was central to economic life. During the Great Depression, countless families lost their homes because money issued as debt could not be fully repaid. John, a factory worker in Ohio, lost his life savings overnight, demonstrating how the legal system redefined currency and the human cost of that redefinition. Fractional reserve banking is the mechanism behind this system. When a bank issues a loan, it doesn't hand out existing cash. It creates new money digitally. That loan becomes both a deposit and a liability. Repeated thousands of times across the economy, money multiplies exponentially. Every dollar in circulation is someone else's debt. Imagine a single mother trusting her savings while it is replicated across invisible ledgers she cannot see. Debt isn't just a byproduct of money, it's the foundation of the system. The 2008 financial crisis illustrates this vividly. Banks issued trillions in mortgages, many unaffordable, bundled them into securities, and sold them globally. When defaults surged, ordinary people like David in Michigan lost homes, while banks were rescued. If money is debt, who controls your wealth? The post-World War II economy expanded on this principle. Governments financed infrastructure with bonds, banks leveraged deposits to issue loans, and corporations grew through credit. Economic booms relied on issuing new debt, and the system functioned like a snowball, building momentum as long as borrowing continued. Silicon Valley startups thrived in the 1990s due to cheap money. But when the dot-com bubble burst, debt's fragility became clear. Employees were laid off, startups dissolved, and dreams vanished, while banks continued as if nothing had changed. Laws codified debt as currency, allowing banks to lend against deposits and treat loans as money. The system requires perpetual borrowing to keep moving. Without debt, the economy stalls. Crises of debt recur throughout history because excess borrowing inflates bubbles, and unpaid obligations can ripple like earthquakes through the financial system. From 1837 to 2008, the fragility of debt as currency has been evident. Families were evicted, retirees lost pensions, and communities The law protects banks, ensures debt remains currency, and leaves ordinary people to bear the fallout. Today, the economy is defined by record government debt, personal credit, and corporate borrowing. Money is largely digital, created instantly by banks with legal authority. Interest rates, fiscal policies, and central bank actions influence the flow of debt. As systems become faster and more complex, shocks can cascade with unprecedented speed. Young professionals take on massive student debt, shaping their purchasing power and life choices. The law that made debt our currency now shapes entire generations. Despite bailouts, stimulus programs, and temporary regulations, the core mechanism remains. Money is born from debt. The cycle perpetuates itself, with banks at the center and citizens carrying the risk. Every created dollar is a promise someone must honor. Financial literacy becomes critical for navigating this system, empowering individuals to identify leverage points, assess risks, and seize opportunities. Words like legal tender, collateral, and obligation carry real-world consequences that affect everyday lives. Looking ahead, digital currencies, programmable money, and decentralized finance may redefine this system. Who controls money when algorithms replace traditional banks? Can individuals maintain autonomy in a debt-based economy? These are questions that set up the next exploration. Will digital money break or reinforce the debt-driven system? 3 actionable takeaways. First, understand that most money today is created through debt, not earned or printed from gold. Second, monitor interest rates, borrowing trends, and fiscal policies to anticipate systemic shifts. Third, strengthen financial literacy to protect yourself in a debt-driven economy. Share your thoughts in the comments, spot hidden patterns, and subscribe to uncover more financial rules hidden in plain sight. Because the real question isn't just how debt became currency, it's who survives when the system shifts again.